We're going to jump now to options trading. So there's a non sequitur here for those of you that are going to send me emails. Don't send them, because I will take those emails and I will put them out on social media and out you. So we're making a non sequitur jump now to options trading. There's a lot of old timers that say 90% of options expire worthless. And I'm saying, okay, well, let's put that in context. But where does the retail investor get it wrong? Do they put too much emphasis on either implied or historical volatility, or did they buy, out of the money options that, short dated that need to see 40% moves in order to have any kind of premium that's worth having?
I think the biggest problem for option traders rather than stock investors is that a stock investor migrates over, becomes an option investor. They don't really understand that these are for a trade. Options all have an expiration date. Stocks generally don't. Although Enron and WorldCom and some others might sort of lead us down the path, maybe some of these Chinese IPOs,
right,
reverse IPOs, that maybe some stocks have expirations as well, but at least it's not a stated expiration. With the option, that there's a time when that option is going to turn into something or nothing.
Right.
So to your point, Michael, if 90%, I think that's probably a little high, but if 90% did expire worthless, at what point did the option go into the money and somebody could have sold it at a profit, pull back and finished out of the money whereby It was worthless, whether it was a call or a put, and you just need to trade these things. Right. So just as I said on the panel, I'm not Warren Buffett. I am a guy that rents stocks, I don't own them. Warren wants to buy a stock. If the market closes for 2 years, he says, I'd be happy owning this stock. I wouldn't. I want to be in that stock either through options, futures, or in the underlying stock. I want to be in that stock, and I want to rent it for a certain period of days, moments in time, whatever it is, and then I'm going to trade out of it. So if you applied my methodology, where when I buy that option, if the option doubles in price, I sell half of it, or if I lose half of the option investment, I dump all of it, I think you'd find that applying that same 90% finish worthless, right, you'd say, boy, maybe 90% of my trades I make money. Because the problem is that customers in particular are relatively good at buying, but not so great about closing their positions. With options, you have to close the positions.
Opening, purchase, closing, sales, absolutely. I have a few things to say about that. I think Warren Buffett's the most misunderstood person on the planet. I mean, I definitely think if you look at the statistics of his returns, he has absolute talent. The randomness part of it is that he had 50 years of a raging bull market behind him. He had a dad who sat in the house, and his father who had a brokerage firm. So he was a very, very well-connected guy as well.
Yep.
There's a lot of things that he had going for him, and he certainly made the most of it. You can't take that away from him, right?
Nope.
But I don't believe in the concept of buy and hold, as in buy and forget. I think in a lot of ways entries are irrelevant, and you can and tell me if I'm wrong, because people are going to look at you as a more credible source than me. They don't really know me. They don't really know me that well, but I will argue that you can absolutely time the market to keep your losses small. Entries are in a lot of ways to me irrelevant. I could buy corn, sugar, cocoa, coffee, and
silver.
I can still be a slave to silver, and I don't have any positions in the things I'm speaking about right now. As long as I know where I can get out, regardless of my entry, I can keep my losses small, and that's the single most important thing in investing and in active trading, right or wrong.
Oh, that's right. That's right. And what I do, to your point, Michael, and for all the folks listening, watching, I try to quantify my risk on entry. And you can do that with options, because I know if I'm buying an option for 50 cents, that's the entire risk I have on the table. Yep. If I sell another option against it, I have even less risk on the table, as long as we're talking one-to-one strategies where I buy one option, sell another, like a call vertical spread, yep, or a time spread, or whatever it might be. I can absolutely quantify my risk. I know if the stock opened down 30% tomorrow, I'm not going to be cleaned out. If I was bullish and it opens down 30%, I'm not going to make money, but I also know that I'm going to have small losses. And one of my favorite expressions in trading is you can't eat like a bird and defecate like an elephant. So you can't make little tiny gains over and over again in one big loss, but too many investors do exactly the opposite of that. And I think that's one of the things you need to address with your own trading. You can address that through options. And so whether you're learning them from Michael or whether you're learning them from me, this is something that you should understand, because they can absolutely help you be a better investor.
One of the things that our mutual friend Larry Schober mentioned in his book is that when you look at buying premium, calls or puts or net debit spreads, that's a built-in stop loss.
Yep.
Just to your point. And I thought that was a clever way of saying is I know it's 50 cents or $50 for every lot per contract. I know what my loss is walking in the door.
Yep.
And that, to me, is good risk management because like in golf, it comes down to course management. If I can look across my portfolio and see, okay, here are all my max losses emotionally,
right,
I can sleep at night and I know what the worst case scenario is before it may ever happen.
Right, and I think that's key, Michael, to knowing, I mean, if you own Apple outright, folks, great stock, but if you own Apple outright, you have no idea what your downside could be. You have no idea if something bad happens, and I don't want to wish it on either Stephen Jobs or anyone within the company.
Sure.
But if something bad happened and that stock opens down 20%, when it's a $350 stock, that's $70. So that's a life-changing experience for many of you if you had 1,000 shares or if you had 10,000 shares. That's going to change your life. However, if you had a bunch of options on, and you had a limited amount of risk, to your point, 50 cents, for instance, that's $50 for every option, and every option controls 100 shares of stock. So in other words, a 10 lot would be just $500 worth of risk. Stock opens down $70. I know my total exposure in that trade's $500. So in other words, I'm taking a small slice of the market and giving myself, I'm moving the odds into my favor and moving the odds on the loser side also to protect myself.
And of course, you and I wish we could find options priced at 50 cents on Apple.
True.
On some level.
But with the weeklies, you will find that you can find spreads, a bull call spread, which for instance would be buying the 340 call, selling the 345 call. That would be a $5 bull call spread. In the weekly options of Apple, if that's like a strike or two out of the money, you can frequently find that for probably that spread for 75 cents or a buck, which would mean $75 or $100 per option spread. And that's a very reasonable way to play it with these weeklies. That's why I love trading weeklies on Apple.
Well, that's going to be our next lesson. I want to have one more question, but I want you to promise. I want to do a lesson with you.
All right.
We'll tie in Option Monster on where do you put a vertical spread, and don't answer this because we want people to kind of come to our websites.
Okay.
Where do you place the vertical spread in relation to the chart? I get that a lot, and I figured I need to bring in an options pro to help me with that. We talked and we joked before about a stock that you want to buy on Saturday. Well, guess what? If you have an option and you're long a call, you are long or short. You're long in this case over the weekend, so you don't have to worry about any gap on Monday morning and getting in the pre-market activity because you already have it. So if there is an issue with health or there is an issue with, 300
a product having some weird thing. What if all of a sudden they said this particular product has a bunch of microwaves that were found to turn somebody's brain to mush or whatever, and people panic? There could be all manner of things in any stock that could cause it to react negatively. And one of the things, if I have an option, like let's say I had naked long puts in a particular stock and it opens down $10 on a bad earnings announcement or whatever, I can cover in the pre-market through that Trade Monster platform. That's my brokerage firm, folks. I can cover in the pre-market buying stock against those puts and take advantage of it. Many other folks would have to wait until the market begins to trade. And if you have pre-market access and post-market access, you can actually trade earnings and special events much more effectively, because every once in a while, you get a big home run in the pre-market or the after hours. I try to post those on Twitter a lot when I'm seeing unusual activity in the pre or post-market, and I'm usually telling you I'm buying this or I've just sold that, and posting up a ticket from Trade Monster showing you how easy it is that we did it.
I'm going to talk about selling naked puts. It's a great segue, and being short gamma in general. There's a really, really brilliant trader out there, I don't want to mention any names, Victor Niederhofer, who wrote a book called
The Barefoot Trader.
Right, who wrote a book about how he gets his stock ideas from the Inquirer. And brilliant as he might be, he's blown up twice now by being short gamma with S&P 500 puts that were not hedged. On the other side of those trades is a guy named Nassim Taleb, who is buying disaster functionality on some level.
He wants the black swan events, hence the name of his book.
Yeah, right. So here you have one guy who's living inside the fat tails, and then you have the other guy who's selling option premia underneath the greater or the fattest part of the bell curve.
Right.
Now, they're both I haven't met either one of them, but they're both rumored to be fantastically intelligent men.
I've met them both, and they are. And
So-
nice people, too, actually.
I have no doubt. Explain to the person watching what eventually, though, if they both understand VAR and they both understand the mathematics of expectation, what would lead one person to be an option seller versus being an option buyer? Because we just laid out the fact that they were probably they're contra brokers to one another.
I'm sure Victor Niederhofer, as bright as he is, would admit that he should have had the tail risk covered. In other words, folks, you can be a premium seller. You can do what Victor Niederhofer did. Victor, more or less, I'm sorry to say it, Vic, but you violated the PIG principle. PIG principle is you put too much risk out there. Instead of selling those out-of-the-money puts in the S&P and maybe out-of-the-money calls as well, and saying, I think 95% of the time the market is going to stay between these 2 points, above and below where the market is right now, well, that's what long-term capital did too.
Right.
And they had considerably more money in the markets than Victor Niederhofer did. They may have been up to 20% of global fixed income at one time. Well, but all of a sudden you get something like Russia doesn't open for a week,
Right.
which is what killed long-term capital, among other things. And so they couldn't continuously hedge. If they would have sold those out-of-the-money calls, sold those out-of-the-money puts, and protected it beneath the market with a put
Right.
and above the market, they'd have made this much less money. But over the course of a year, they'd say, God, if I hadn't have bought those puts, look at how much more I would have made. Unfortunately, on that black swan event where the market does jump up on a terrorist incident or on a melt up on the Fed giving us QE3 or whatever it might be,
Or
those
Osama bin Laden.
or Osama bin Laden,
Yeah.
those tail risks on that bell-shaped curve are enormous. And I want to sleep at night. I'd like to wake up and kiss my wife good morning, and I don't want to be thinking suicidal thoughts that you'd be thinking if you sold out of the money calls and out of the money puts and didn't have that protection.
John, this has been a great honor for me. Thanks for
Likewise.
your time, buddy.
Thank you,
And,
Michael.
Look for more information on the blogs about these lessons that we want to do, because I think
Sure.
that'll help steer
Yeah,
people
we
in
should
the
do
right way.
one of those together.
All right.
You and Vic and I, we should do something like that together. That's a
would be-
teaser, folks.
Thank you very much, Mike
Thank
Martin.
you.
Take care.